Hey man, hope not.
Yeah, my wife.
Okay. We're gonna get it poppin'.
Alright, we are here. Okay, everybody got their water. And then we'll pour this later.
And here's what we'll do.
Okay, babe.
Simply because, when it first kicks off, and when you, Oh, okay, so that's all good. First things first, everybody. I know people are joining, so as people join, but we got to get the show on the road. Real quick and easy, thank you to everybody for tuning in to another yet poppin' wine and real estate, where we bring you two sides to the culture, where we're bringing you some wine education from our newly level 2 certified wine enthusiast.
Specialist, okay. I've
Specialist. Excuse me, specialist. So we got her, my wife, who is to the left of me, and then our special guest for tonight, Jonathan Soto, who has helped us at least. I mean, in the past year, we bought 8 units straight, and he did all the financing behind it. And there's a reason why, and there's a reason why he will continue to finance all of our deals. So we wanted to bring him through tonight so that way he can talk to you about what to expect for this year if you're looking to purchase the first home, the next home, what mortgages that are out there and available to you, as well as what you need to do in order to qualify for said mortgage. But I know I've been talking already a little bit too much. Take it away, Jonathan. Just give us a quick bio, and then Asia's gonna kick us off with the wine of choice for tonight, which is Pinot Noir.
Hey, my name is John Soto. I'm a mortgage loan originator in the state of New Jersey. As Austin mentioned, I also am an investor in Jersey and was able to utilize FHA like these perfect individuals here as well. So if you need have any questions or concerns on both aspects, I'll be able to help you.
Perfect.
All right, so we are going to try to keep this within an hour. We're going to be mindful of your time and also our time as well. Austin honestly just wants to get off so he can watch the Knicks game. So we will go ahead and jump right on into it. So today we are going to be discussing and tasting one of the noble grapes. So it's like about 7 noble grapes. We're going to be talking about Pinot Noir, one of those grape varietals. So just a few quick things about Pinot Noir. It's a black, thin-skinned grape that primarily grows in cool to moderate climates. Some things that you can sort of smell, or some of the characteristics about Pinot Noir are: one, is typically pale or medium in color. You may get lots of red fruits when you're smelling. So after we do our little swirl thing going on, you'll smell probably some red fruits, some earthiness, some forest floor, some mushrooms. What else might you smell? Spice. Those are just a few of the things that you may smell when you sort of taste, or when you are tasting Pinot Noir. And I chose this specifically for so many of my friends who reach out to me and say, oh my gosh, Asia, like, I want to try a red wine, but I don't want it to be too dry, and I don't want it to be nasty. So I think a Pinot Noir is a perfect place to start. It's red, so if you like sweet wines or red wines or white wines, I think it's getting you out of your comfort zone just a little bit. But I think it's fruity, it's light bodied and light to medium bodied, so it's not going to be as bold as a Cabernet or Syrah, those very bitter wines that when you taste them, a lot of people are just like, oh my gosh, this is so nasty. So I'm hoping that you guys will feel the same. So let's go ahead and just jump right on into it.
Can you tell about the WSET, just certification? I'm sorry, but we got to get proud
yes,
of that.
Oh my gosh.
So what does that mean? What does that mean?
Well, so essentially means that I've just been certified to, discuss wine, its origin, some of the characteristics about some of the grapes. So understanding So for example, we chose a California Pinot Noir and we chose one from France. So understanding that the different regions and the different terroirs, so the ground, the soil, how all of those sort of impact the characteristics of the different grapes that we have. So all red wines are not created equally. All of the same grapes are not created equally. So we're going to see, hopefully, if this all goes well, we're going to see how a California Pinot Noir can differ from a French Pinot Noir. So we're only going to do 2 tonight, but I think that's sort of what the W set prepares you for. So I actually just got my pen. I'm wearing my The Future of Wine. It's black shirt. Shout out to Wino Noir and the Wino Shop. And I just didn't want to wear my pen because I didn't want to mess up my beautiful shirt. But intermediate level certification. I'm trying to decide if I want to go for the W set level 3. I don't know for sure. But we'll see how it goes. But without,
and just bring us through the how do you taste wine, just for anybody that's new. Just bring us to what are me and Jonathan gonna be doing?
Yes.
Just to make sure that we do it correctly.
This is my first cup of wine, so
and this is the first time. I don't know if these are taste tested, to be honest with you.
Yeah, so these are, so in reality, this is not a tasting size really, and usually when you're tasting, you're actually supposed to spit it out, right? You're supposed to have a spittoon, you're supposed to taste, and then you're supposed to spit it out. But we're not gonna do that. So that's why we only have 2, and we're gonna take it easy with something light. So if you've been with us before, actually before we jump into the tasting, just a little bit about the bottle. So this is the Pinot, this is a 2018 Pinot Noir from California by the Pinot Project. I posted this on my page if you're interested in getting that. This is the 375 milliliter bottle that we have here, so it's a little bit smaller. But it tells you on the back what you should expect. I'm not going to say anything yet. I'm going to see if these guys can sniff out any of the things.
The pressure's on. The pressure's on.
I hate this.
Guys typically have a worse sense of smell than women do, so we'll see. They probably might not be able to smell anything, but we'll see. We'll see. So the first thing we're going to do is we're going to see the color. The lighting in here is crazy, but you can tell if it's pale or medium if you can see through it, right? So pale is like, is it almost translucent? Can you see? So it's medium because it's not super clear. We can't see through it. Okay, so this is a characteristic of a California Pinot Noir. So we're seeing, I would see medium. Medium. What colors do you guys see, especially like around the rim? If you think about you can see the rim. What colors do you see? I'm seeing purple. I'm also seeing purple as well. So we're gonna say a medium. Purple. That's what we're seeing when we look at it. So the first thing is to see it. The next thing is we're going to swirl it so that the aromas can sort of get aroma against the you're so funny. To swirl it so the aromas can release against the glass. And then after we swirl it, we're going to smell and we're going to think about, based upon what I said before, what we should smell from here. All right. Let's make it easy. So black fruits, red fruits, think strawberry. Do you smell blackberry? Do you smell leather, tobacco? Okay, so we have blackberry. Let's see. Yeah, something super tart in there. I would say even a pomegranate.
Yeah. Grapes.
Sometimes grape can be a flavor or aroma, but
like a strong
not
flavor,
in this.
like a strong flavor though.
Yeah. Okay, so we got blackberry, some plum, a little bit of plum in there, some pomegranate. Any strawberry? But we know that it's red, right? We wouldn't smell green apple in this. See, so those
and
are
I have
the
to
things.
bust Jonathan's chops, unfortunately, but
What?
we've learned how to hold wine glasses.
And
this is etiquette. I've learned
first
myself.
cup of
It-
glass.
yeah.
Listen, I used to be like this.
soaking it all in.
That
Let me
is
know.
so funny.
Let me
know.
So Pinot Noir should also be served slightly chilled. So you don't want to hold it at the bowl because that heats up the wine that way. So let's go ahead and taste it. We've done our see, we've done our swirl, we've done our smell. So now it's time to sip.
You told me that.
Sip it. Okay, this is dry.
I took a shot.
Yeah.
I took a shot.
Jonathan took a shot.
I took a
So
gulp.
this is, and honestly, it may need to aerate just a little bit.
It's a little dry.
Well, it is dry. So Pinot Noir is going to be dry, so it's not going to be sweet for all of my sweet lovers. But it is fruity. It doesn't taste and it's not super tannic. So that grippy feeling that you get when you know, like the skin of a grape.
I like the gripping analogy. It's a very
What goes well with this? What would you pair if you're eating something?
oh, good question.
Yes, it's very important to like pair wine with the right food. So from the research that I've done, in terms of cheese, I've seen goat cheese a lot, and there's this other cheese that I can't pronounce, Gruyere, G-U-Y-E-R-E. Those are some cheeses that I've seen go well with Pinot Noir. Chicken, duck. I'm not eating duck, so I don't know if that's eating right, but I'm not eating duck. What else? Sometimes pork, but I've seen a lot of duck, chicken, and depending on the type of beef. But you know, the sauce is what's important. But if it has mushrooms, sometimes that goes well. Pinot Noir is hard to find food pairings with, but salmon is one of them as well. But I would just do like I do. I research it. I base my foods either around my wine or I base them around the foods, and then you'll be able to tear from there. But what do we think? So we did the sea, we did the swirl, we did the sip, we did sea swirls. What is it? Oh, and sip, yes. See, swirl, smell, and sip.
And
now it's, yes.
And now you think about it.
Study, yeah. So what do we think?
Study.
Is this
Okay. Oh, those are
according to what the Pinot Noir characteristics are? I would say this is a good version of that. Yeah, it's not sweet. It's smooth. Are you guys getting that it's like fruit forward? I get fruit without the sugar. Like if it was like a airy,
I would say that.
unripe something. Yeah. You good over there? I don't know if Austin likes it.
Yeah, this one's
I feel like if I drink 2 cups of these, I'll get very thirsty.
Yeah. I'll get very thirsty.
Because of the dry.
And floral. I just smelled some floral in here too. Honestly, I say because I didn't open it, let's let it aerate just a little bit to let it open up a little bit.
Okay.
But while we're doing that, or while Austin finishes, we'll go ahead and we'll talk about the good stuff, the mortgage, all that good stuff. So, I guess what are some of the first things that people should think about in terms of like how do they know which mortgage to choose? I get a lot of people like, well, should I do FHA or should I put 15% down? I have the money. What would you say to someone who's trying to figure out which?
And can you break down like the types that they can go after first and then like dive into it?
So there's many different loan programs out there. Number one that everyone's aware of is FHA, the lowest money down, 3.5% down. Then there's a conventional loan, which actually does offer a 3% down, but there's certain criteria to qualify for that one. So for most individuals, it will be 5% down minimum. Then we have the VA loans, which is 0% down, but you have to be a veteran for that one. And then we also have another 0% down, which is called USDA, but that's more for rural areas. And so they go based off population of the town and different criteria. So Essex County doesn't really have it, but if you go a little west to Morris County, then you can find cities that you can utilize USDA loan.
And does USDA also allow you to go after like a not multifamily?
Oh, single.
So just singles that for USDA. Okay, so USDA only allows you to go after singles, and then you have to be in a rural area. So anybody that's living in Jersey right now, you're screwed, unfortunately. Unless you're out west, I guess. Unless you're out west.
If you're out west, maybe south as well, but yeah.
You're 30 minutes outside of the city.
If you're closer to the city, then no. But if you're going a little drive, then possibly, yes.
And so if you're trying to get a multifamily, and people ask, can I get if I already own a home or like I really want a single family, what would you recommend is the best loan for people who either want a multifamily or they already have a home, but then they want to get into the multifamily game?
Okay, so the first one is someone that doesn't own a home. I would say 100% FHA multifamily home.
Why?
Get your first house as an investment property, because if you want to go the other way around, you're going to have to put more percent down. So let's say your first home is a 3-family. You would have to put 3.5% down and you're going to live in one unit. It can be rent-free or your expenses are less than what you were paying before.
Mm-hmm.
And then after that, you can buy your single family house and use, depending on the property itself, you can use that income to buy a bigger house maybe.
True.
Depending. But if you go around and buy a single family home first and then want to buy a multi, you would have to put 25% down minimum in order for that property.
And that's only if you already have a single family and you
Yes.
want to get a multi-family.
Yeah, because it will be considered an investment because no one's going to leave their single family
Right, to
to
go
live in
live
a multi-family.
Mm-hmm.
Yeah. So you have to improve your living, not worsen it.
Yeah.
So
Interesting.
Yeah.
So let's break it down, right? So we have FHA, conventional, VA, USDA, right? And for the most part, people are starting to get their finances in order. People are thinking about like, hey, this is going to be the year where we try to make a move. What are, the biggest question is, what are the lenders looking for? Like, what is, do they just apply? Like, what's the, process like? What are they looking for? What are the lenders looking for?
How I like to break it down, there's three main factors. I like to think of number one is income. The more you make, the more you can qualify, but we also take into consideration debt.
Right.
We're gonna have to spend some time
Yeah,
on
We'll
that.
talk about student loans. We'll come to that in a second because student
Yeah,
loans got us shackled.
Let's
But
divide it, but let's talk about the main three categories. The income, that's number one. That's a little harder to change because whatever you make is what you're gonna make for now if you're in the market now. Number two is credit. Credit is temporary. If you have bad credit now, that can change. Sometimes it can be changed in 1 month, 3 months, 6 months, but your credit can change. That's why I say number one is income, because income is harder to change.
Right.
So we have one, income, two, credit, and the third one will be assets. Assets meaning how much money you have in the bank to purchase your house plus the closing costs. There's definitely ways around it to tie in the closing costs into the mortgage with a seller's concession, but we can talk further that once we get into that subcategory. But those are the main three factors.
And is the expenses or the debts, is that factored into the income? Like, are you saying number one is the most important is the income, but is that the income by itself, mean like net, like gross, like whatever they make, or are you looking at it from okay, here's your income, here's your monthly debts, and then whatever, so your income minus your debts, and then that number, does that become your quote unquote income for number one? Like, where does the debts or expenses come into play?
Great point. So we definitely take into consideration debt. So let's say you have high income, but high debt, can't really do much with that because you don't have money left over to pay for a mortgage.
Okay, all right. Only because.
So let's go for it.
Student loan debt. Ooh, child. Tell us the real stuff about debt, right? So many of us have student loan debt. I'm sure it varies, how much you make versus how much you have in debt. But let's talk about student loans specifically.
And the forbearance aspect of it too, because I think there's, you know what I mean, with COVID and forbearance and
Please tell us, just tell us the real. I don't know if there's a threshold, because again, I know it varies based on how much you make, but have you been in situations where folks maybe have the money but have the debt also and weren't able to get a loan? And what can people do to get around that? Because I feel like that can't be the thing that stops people from getting a home. So what would you say about student loan debt?
So let's take a step back. Let's bring the income back into place. So let's say someone makes $10,000 a month. To make things simple, that's $120 a year. So what the bank does, about 46% of that, we're talking about FHA loans.
Okay.
So FHA loans, 46% of that can be your mortgage payment. So let's say $4,600 can be your mortgage, including taxes, insurance, everything, your mortgage payment. That's $4,600. That's the front end ratio. The back end ratio, that's your mortgage plus your debt. So that can't exceed 56.9, but let's say 56%. That's $5,600. So if you have a mortgage of $4,600, your debt can exceed $1,000. That's $5,600 combined.
So, right.
Combined.
Okay.
So your front ratio covers the mortgage, and the back ratio covers the.
Trying to get the time on here.
That's fine. But let's say you have debt higher than $1,000. You have $2,000 debt. Now your mortgage can be higher than $3,600 because together, both have to be lower than that percentage. So if you have higher student loan debts, your front ratio gets hurt, so it decreases what you really qualify for.
Are there any options for these people to still? So if that doesn't work for FHA, can they do conventional?
So with FHA, if you have forbearance, you mentioned forbearance. Let's say your student loan is $100,000, and your payment before forbearance $500 a month. I'm not sure.
Yeah,
$1,000 a month, maybe more.
Just mad bread.
But right now,
mad
your payment is $0. So what the banks will have to do, you have to be 1% of that. That's
on the FHA, you said.
Yeah.
On the FHA, okay.
FHA. That's 1%. That's $1,000 a month. Maybe sometimes your payments can be higher than the 1%, or sometimes your payment can be lower.
Interesting. Is that okay? Interesting.
In order to go around that, you can show the lender an amortized document showing what your payment would be after forbearance. So let's say you have an amortized schedule, $600 a month, until let's say your loan is 20 years, then that balance will be $0. That's an amortized document confirming that after all those payments, the balance is paid for completely. So to go around that, you can show that document to use the 600 instead of the 1,000.
Are there situations, because I know somebody very, very close to me who was in a situation where the mortgage officer was like, your student loans are not going to amortize by the end of the mortgage. So they made her pay money. Can you explain it in a way that's better?
Who was it? If your mind's on the line, I don't know what they were. They
made her pay more or they made her change what her monthly payment was for her student loans, because they said that she would not have gotten to whatever debt to income something was for them to give her, her to get the mortgage.
Maybe the payment that she was currently
was too low.
Was too low or too high?
Was too low, and she had to up it in order to show that it would amortize
so the
in
monthly
time.
Was she on an income-driven plan?
Yes.
That's why.
Oh, yes.
So with FHA, you cannot be on an income-driven plan. So usually your payments are lower when you're on an income-driven plan.
Right.
FHA doesn't allow it. Conventional does.
Oh, okay.
So once you go into conventional, you can use
I wish we knew this before. That's what they switched her to.
Plan. You can use the income-driven plan to use that lower payment to help you buy the.
But you can still do. It's not as low as FHA, but it can still be low when your first time using a conventional loan, right?
5%.
Okay.
And it can be 3% depending on the area and the income.
Okay.
It can be lower than FHA sometimes.
All right, so that makes sense.
So FHA conventional, and we'll talk about we'll dive into we'll double dive into what the lenders will look for, and then we'll go on to the second line. But just to reiterate, just so we make it clear, no matter if they're doing FHA, conventional, VA, every lender is going to look at your income, the credit, and your assets, either what you have in the bank or what you own as an asset or whatever the case. And the ratios will be different, but they're calculated the same. So let's break that down, and then we can talk about how the ratio is different between FHA and conventional. Okay. So either way, you gave the example of $10,000 a month, which over the course of the year is $120,000. There was something interesting about that because you didn't take any taxes out.
Gross. We look at gross.
So you look at gross. So if somebody comes and like, yo, I make $50,000 a year, take $50,000, divided it by 12.
Yes.
And that is their income for the month. And then that income for the month can't exceed X amount for that mortgage, which is based off of whether you're going FHA, conventional, things like that. Okay, so you said FHA is 56%.
Back end, yes.
Back end, okay. We'll use back end just for because I'm pretty sure everybody else has some type of debt. So we're going to use the back end ratio just because the front end is factoring in without any other debt.
Yes.
So we use the back end debt. So FHA, 50%, 56% of your income can't be more than, I'm sorry.
Mortgage plus that.
Right, so your 56% of your income can't go towards more than the mortgage loan and whatever debts. Okay.
Yeah, so we're talking about true debt. A lot of people like to include
and what's
car
debt?
insurance, easy pass toll. Someone asked me about that. You don't really need
Listen,
that.
how
forget
they-
easy pass.
How they coming after me? You would have thought I was doing
So it's
Let it go to collections.
student. Don't get into collection.
That's horrible. Don't
We're not financial advisors.
Don't take
That's
that
what I'm
feedback.
saying.
That was a
So
joke.
good thing you mentioned that. So if you're in collections, that can impact you from a loan. If you're in disputes,
Anything in collections.
any liens. So any disputes, don't have any disputes language on if you're going for a house. Make sure that's resolved before buying a house. So back to the 56%.
Yep, so that's the back end.
That's the back end ratio, yes.
And that's for FHA. All right,
Okay, so now, so that's what I want to mention. It's easier to calculate a W-2 employer. If you're making $120 a year, we could just take your gross and divide it by 12. But when it comes to self-employment, it gets a little tricky. But we can have a separate section at the end for self-employment.
Yeah, if you guys have questions. And remember, please ask the questions. We're going to leave maybe 10 to 15 minutes to answer any questions that you guys may have. So please write them down. I know we're far away. Somebody says easy pass. Yes. I didn't know that.
Listen, you know it's real when you start getting the orange letters in the mail.
Okay.
When you get the orange letters in the mail.
My California people, I don't know if y'all know about Easy Pass. When you don't pay that little toll thing and they start coming after you because all your information is in the DMV system, it's not a good look. So, but I want to make sure we keep
Let's
going.
talk about W9 or 1099 real quick, and then we'll go right into conventional. But just to, just 10 seconds. How do they factor in the income for anybody that's an independent contractor, an entrepreneur, self-employed? You said they can't take it over the course of the year like a W-2. How do they factor it if they made the same amount? Say if they made and claimed the same amount on their taxes, because I know that's important.
Good point. Claim is the main factor. So let's say the bank will look at what you pay taxes on, your taxable income. So let's say you grossed on your business $150, but you had $100 in expenses. Your taxable income is $50,000. So your true income is $50,000. The bank will look at your income as $50,000 a year, and the bank will take 2 years, average out 2 years of your tax returns to see what your monthly income is. So let's say you did that for 2 years in a row. You had the $150, then you had $100,000 in expenses, and then you netted $50,000. You paid taxes on $50,000. You did that the year prior. So what we would do is 50,000 plus the 50,000 divided by 24.
Which winds up still being the 50,000.
Was because that's
But that's just
made it
because it's
simple.
the same.
We made it simple, yeah.
But if it was 70 and 60, it would be 50. Or I'm sorry, 70 and 60 would be 65. Interesting. Okay.
So
All right. Cool.
Yeah, and there's different type of self-employed income. You have the Schedule C, then 1099. So it can get a little complicated. Just reach out to me and I can help you calculate that. Because some people can be self-employed, pay themselves an income, W-2, and then it can get
and that still works.
And if you own real estate, we can definitely add some numbers back into your income. Depreciation can be added back. Taxes you paid can be added back. Interest you paid on throughout the year can be added back. So there's definitely ways that can help you increase your income.
All right, cool. So let's finish off with conventional and VA.
Conventional.
Is the two questions.
Time check.
One
All right.
is the how we looking?
7:35.
Oh, we good. We good.
All right. We're good on time, y'all.
No, we finish it with this, and we debt to we'll do it off at 2. We'll do it off at 2. That's the original. Is that the original?
Yeah,
oh,
yeah.
You can't taste it.
He swirled. Oh my God. He swirled.
So we'll go up the.
All right, let's go conventional. So we
And debt to income. Oh, sorry. Debt to income ratio. The differences and credit or any other distinguishing qualifying factors between that conventional and with
So
OVA.
the two things I'm going to mention, the back-end ratio and the mortgage insurance. So back-end ratio for conventional is 46%,
Oh, so not 56.
not 56. So that's
So
10%
it's a little
difference.
harder.
That's the 10% difference. So your mortgage and your debt cannot exceed 46%.
And that's essentially just because the bank is
Conventional.
taking on
It's
a little bit
stricter.
more risk
It's
for
stricter.
FHA.
Yeah, yes.
Because you're only putting.
And you're paying more the mortgage.
Yeah.
insurance.
Okay. Got it.
So now your total debt with the mortgage cannot
Is this the
exceed
original?
46.
Yes, you just
You
do
drink
it.
yours.
Oh, okay. Yeah, didn't put the new ones? Okay.
So the 4,600 now. So let's say 4,600 is your total debt. That's your mortgage and all of your debts you have, car payments, student loans, everything in place. The front end ratio, just the mortgage, is 42%. So 4,200.
So
I
basically,
had a.
there's not much wiggle
That's not
room.
much.
So that means don't go and buy a car.
Don't go buying cars. So the main difference between both, if you're buying a single family, let's keep things simple. If you have good credit, 700 and above, I would go with conventional, single family, 5% down. If you have bad credit, I would go with FHA. The reason I say that is because FHA, the mortgage insurance stays the same. Doesn't matter your credit score, everything's the same. But when you go into conventional, there's different borrowers pay different mortgage insurance depending on their credit.
Oh, okay.
Oh, interesting. I didn't know that.
Yeah, I didn't know that either.
So mortgage insurance for FHA is 0.85%, so less than 1%. But then when it comes to conventional, if you have good credit, everything's good, it can be 0.4, 0.3. We're talking about less than 20% down.
Oh, wow, okay.
So
And what's mortgage insurance? Just for
mortgage
like, how do
insurance
they
is
pay for
if
it?
you're paying less than 20% on a home, you have to pay mortgage insurance because just in case, for whatever reason, you default on and don't make any payments, the bank can go out to the mortgage insurance to cover your payments and you lose the house. That's the main
So
purpose
regular
of
like car
mortgage
insurance. Car insurance, regular, like it's the same thing.
Basically, yeah. So if you have good credit, definitely go that route because I know I'm dealing with a borrower now. They go on conventional because they have to on a condo and their credit score isn't the best and they're paying more mortgage insurance than they would have done with a FHA loan.
Okay.
Interesting. So if you have a car and you're in a high risk area that it can have theft, you're gonna have higher car insurance.
Perfect.
Same thing is they see you as a risk. If you're putting 5% down versus only 3.5% down,
Yeah.
they're gonna see you as a risk.
And if the mortgage insurance can change if you're putting more down as well. If you have 10%, it can change as well. But there's an algorithm. There's no set answer because it can vary by the house, by your credit, your down payment. So there's a lot of factors that come into play.
So it's like buying a Prius versus buying
Mustang.
a Mustang or a coupe or like a sports car, where sports car people, they think that they're going to drive more, a lot faster and thus increase the chances of having an accident, so your insurance is higher versus somebody that just has a Prius or a minivan, so to say.
Yeah.
Okay.
I have a question. So for people who I said before, like when I told my colleagues that
Listen,
that
y'all
I
gonna
do
leave me out of
real
it.
estate on the side, they were like,
Oh, we finished. Okay.
yes, we finished it. It's a little one.
Okay.
When I told my colleagues I did real estate on the side, one of them reached out to me like, hey, I'm trying to buy a house. I have the money to put down more. So if you get someone who's like, I have the money to put down more.
How much percent?
Let's say if they were instead of
15%. That's usually what people say is like, oh, it's not 15%. And I'm like, where did y'all get this number? Like, who? And I don't know. It could have been their, I don't know. But let's say they have 15% saved that they are able to put down towards a mortgage. Would you recommend that? Or does it vary based upon the people, their goals?
Interesting question.
Would it make them broke after we put the 15% down? If it does, then I would say no. Because anything can go wrong in the house.
Right.
You can gotta do repairs in the house. It's always good to have that cushion and have money in the bank. So I wouldn't recommend someone being broke, being what I call house poor.
Would they still allow you, would that still be able to be a thing?
Yeah.
Can you still just say, you know what, I have $30,000 or $15,000 or however much in my account, like I don't care, I'm really gonna go broke for this, I'm about to put all of it down, can they still do
single
it?
family, yes. But if you're going to multi-family, then they need you to show reserves.
And then that's when you can probably ask for a gift or that sort of thing.
Yeah,
right?
so the actual reserves money can't be a gift. It has to be your seasoned money. But the down payment can be a gift.
Oh.
So let's talk about that. Let's gifts And yeah, let's talk
Can we
about
talk
gifts.
about that after my second one?
Yeah. Let's take a break.
Can we finish that and then do it? Because gifts is a very prominent like aspect of it, and gifts like first off, explain what a gift is, and then if you're able to like which loan you're able to do that for. Because gifts are very like it's a very
amazing thing. If you can
Very
get one,
amazing
if you
thing.
can give one, I think I don't think this struggle culture of like I did it all by myself and like that's cool and that's great too and big ups for you for doing that. But at the same time, like know when to ask for help if you have the family and the friends and the people who willing to do that for you. But go ahead.
Yeah, so FHA allows you to give a gift. With a gift meaning a family member or close friend can give you a gift for the down payment. So that's a gift. FHA allows you this. Basically, the whole down payment can be a gift. When you come
That's
into
so crazy.
conventional, it gets different. There's barriers. So if you're putting a certain percent down, only a certain percentage can be a gift. But if you go
Okay.
higher, then that varies as well. So it changes for conventional.
but they still have to qualify individually.
Yes, you still have to be able to buy the house.
Do they want to see like so if somebody's able to qualify FHA 3.5% down, they have the down payment in their bank account, but they can go get a gift from Aunt Sandy, and that's funny.
Don't be using my own
They can get a gift for the entire down payment and not have to pay the down payment.
Yeah, we have to get a letter from the gift saying
Interesting.
that it's
And
You have to see the down payment in the borrower's.
account.
Okay, so they won't be like, hey, I qualify income and credit wise, but I don't have the down payment money, but my aunt's gonna give it to me.
That's fine.
That does work.
Yeah.
You have to qualify them on a monthly basis based off of the interesting.
wait, so I was gonna ask, so if you're gonna give somebody a gift, this isn't like a co-signer, right? So their taxes, their information
point.
isn't going to be
We'll need to look
required.
at 1 month bank statements to make sure that they have the money.
That the people who are giving the money actually have the money.
And making sure that it's not cartel money. Like let's be real.
exactly.
Like, we want to make sure
that you
that
mentioned.
If I get my money however I get it, then mind your business.
that's cool. I put $1,500 in the account. They were like, where did this come from? I'm like, it's mattress money.
Yeah,
Oh my
real estate
gosh.
is the highest money laundering business, so that's why
Interesting.
underwriters will double check, triple check, just to make sure there's no funny business.
Ooh, all right, hold that right there because I want to fight
Underwriters?
so many underwriters, so many people who prevent me from closing on houses.
You come over here,
But-
just so Jonathan's camera can see you.
Oh, okay.
'Cause you're not in it.
But before we start talking about the actual, not the entire process,
Finish the last one?
we're gonna skip.
Well, I've been finished. 'Cause
Jonathan
that's
is
my
still
whole
working
thing.
on his
Finish that. Let's go to the next one.
Ooh.
Is this the new one?
Yeah.
I took a shot, guys.
Oh, okay. You know what? Drink,
I
and
didn't
you know
think-
what
I
we're
didn't think
doing?
before.
We're drinking water in
So you get
between.
authentic.
We're drinking the water in between because no one has time for a wine headache. So drink your water in between. We 30 plus years old. Anybody got time to be drunk off no wine, okay? Because this wine will get you super sick, okay? If you haven't had a wine hangover before, it's not fun. It's not fun. So what we're gonna have right now, we're gonna have thank you, Vic. We're gonna have Lulumi, which is a French Pinot Noir. And also a fun fact about Pinot Noir is often in lots of they use a Pinot Noir to make a lot of sparkling wine. So Chardonnay for champagne. Pinot Noir also can be added to champagne or blended with Chardonnay and Meunier for champagne. Cremant, they also use lots of Pinot Noir. If you see, what is it? Blanc de Noir. Is that it? Is that right? It's escaping me. But Pinot Noir is also in a lot of sparkling wine. So FYI, if you didn't know that. Just a little fun fact. And wherever you see Chardonnay, you're going to find Pinot Noir because they're both grown in the same region of Burgundy, France. So they're, like cousins, one red, one white. So just a fun fact about Pinot Noir. So if you ever are in Total Wine and you want to find a solid Pinot Noir, walk down the aisle go to the Old World section, which is pretty much all of Europe. And then go to Burgundy. Yeah, so when we say New World, if you see anything that says New World, that means like the US and other regions that are not Europe. But if you want Old World, you're going, Europe, France, Italy, Spain, those places.
So only Americans. So
No.
like Napa Valley is like New World for the
New
most part?
World, yeah, but like also
Because
random
that's where
places like South Africa.
That's New World?
Yeah.
South Africa's New World?
No, anything that's not Europe.
Oh, okay.
Yeah,
okay.
anything that's not Europe. So let's hurry up because I know we want to get to questions and we want to make sure we answer everything. I see people laughing, but I can't see what they're saying. Oh, I see Liz saying something. Hey Liz, love you. So this is Pinot Noir from Pays d'Oc. Oof, I can't remember. Listen, I had to look this stuff up because I want to make sure that I pronounce it properly when I go back to France, to the south of France, and get my life. Is this from the south of France? Yes, this is from the south of France. This is actually created by a family who lived in New York and they moved their family to France. So we're going to try Le Lumi Pinot Noir, and it's vintage 2019. So if anyone asks like what vintage it is, it's the year. So if someone asked me my vintage, I would say 30. And whatever that would be. Yes, vintage is the year. If it says NV, that means non-vintage. So it's probably blended with grapes from different years. So there's no way to tell.
It's on average.
No, different harvests and things like that. So no, there isn't. But let's go ahead and let's do our guesses. So. Okay, I'm seeing a lot of the same thing. Okay, so
I see this one's darker.
Is this pale?
One's more purple.
This one's a darker.
Okay, so this color is a little bit more sweet than the other. Is it still pale? Is it still medium? It's not pale.
I think it's darker than the thicker than the last one.
Okay, so maybe a little bit has a little bit more. Definitely not a lot of body because you can tell by the.
I feel like the purple color is deeper.
Yeah, I think the color.
Yeah.
Tears, but this doesn't have any tears. So light body, we're saying that it's purple. I see a little bit of red in here, but it could be the light as well. But I would say medium purple. It's not deep like a Cabernet where you can barely see through it, right? You can at least kind of still see through it.
I feel like it's a darker purple, but it's lighter.
But it's still light.
Like you can still
swirl and smell.
See, swirl, smell. So we're gonna swirl. All right, this one we let sort of aerate. We just let it decant just a little bit. I didn't use my decanter. But just let it open up just a little bit. I think that's what we did wrong with the first one. But to me, it already smells a lot different than the other one.
Yeah, more robust.
It's a little sweeter, no?
No, I smell. To me, it has a little bit more earthy, herbal kind of smell to it.
Really?
Yeah. Yeah, it's not as fruity. It's not as fruity as the other one. The other one was like I smell fruit immediately. So the California, which is typical of like Pinot Noir, depending on the region. So California, you may get more fruit forward sort of aromas and flavors, and then for French Pinot Noir, you may get more earthy.
Is Pinot Noir the type of grape?
Pinot Noir is the Pinot Noir is the grape itself.
So kind of a stupid question, but grapes that we get at like Whole Foods or whatever the case.
No.
Like what grapes are those? Are those like
I don't know what kind of grape. House grapes? I don't know what
house
the hell.
grapes?
You don't want no wine with those. I'm not entirely. I'm sure you can make alcohol. Any fruit you can make alcohol.
Okay.
I didn't mean it to be funny. I actually get what I said.
But then there's the house liquor, so it makes sense. So like when you get
stuff you shouldn't be drinking. All right. I smell earthy. I smell ooh, yeah. Forest floor is actually Forest floor is actually an aroma that you can smell. All right, so we did our see, swirl, smell. Let's sip it and see if we taste any differences between the California and French.
Stronger taste to it.
I think this is a lot smoother than that one.
No, maybe
and I feel like it's probably because we didn't let
stronger
this.
Taste, but stronger taste, but you don't feel like they're gripping like the first one did. I feel like the first one had more tannins and more like stuff to scratch your throat.
Yeah.
Let me see, because I still have both, and they pretty much look alike, but ooh, very fruity. Oh my god, very fruity, and then Yeah, very different. Very different. Actually,
Is one more than the other?
One, smell that one, swirl that one, and then smell this one.
Oh yeah.
You smell the difference?
Fruits, yeah. Look.
Smell that one, swirl it.
Yeah.
Yeah.
So
No
proof that
questions.
even though they're the same grape, all wines are not created equally. They're the same grape, so they're still the Pinot Noir grape, but they were grown in different regions. So the different regions, the climate, all of those things impact how it tastes and the various characteristics of that. So with that being said, let's spin our last. All right, we're at 7:52. We are just in time for us to talk about so what is high level, super high level. Who are all the key players in the mortgage? So we know it's the mortgage loan officer, the mortgage officer, whatever you want to call them. The underwriter, who I feel like is the devil, him or herself. No shade to any underwriters here. We love you and we thank you, but sometimes y'all just be annoying.
We don't know.
Who are the people involved in the process?
You have the loan officer.
Yes.
Then you will have the processor, which is kind of the middle person between you and the underwriters.
Okay.
Sometimes I can help as a processor, I can request documents
Just a little
and
bit,
things
just in
like
case
that. I can definitely, the process is the middle, and the underwriter. The main reason why you dislike the underwriter is because
she's nosy. He or she is nosy.
they have to ensure that they're going by the Fannie and Freddie guidelines. So there's specific guidelines to give you the loan in itself. Remember, you're getting a loan for a house, $300,000, $400,000, $500,000. It's not a $5,000 loan that you just walk into the bank and sign something and you're out with the $5,000. You're getting a loan for a house. So they're gonna double check, triple check to make sure. I know you provided pay stubs last week, but they want to just make sure you're still employed. So they need updated pay stubs. They're gonna go by a rule list from Fannie and Freddie, or whichever loan you're getting itself, to ensure, okay, this is checked, okay, all right, this is no good. You're gonna have to prove this item right here, and that's the reason why. It's a lot of stuff that goes behind the scenes to process a mortgage that a lot of people don't see, but it's very, very tedious.
What gets people caught up the most? Because
when their paperwork is not together.
Ooh, what paperwork?
So if you don't have all your pay stubs or your bank statements, all of your IRS, if you have your money in all different types of banks, they're gonna request all those bank statements. All those statements. So it's easier and cleaner to have all your money in one account. Just if they request bank statements, okay, send this bank statement. Okay, you don't have to download 5, 6 different bank statements.
Yeah.
Makes sense.
That's an excellent point. What stops deals from closing the day they're supposed to close?
It's a lot of stuff. Title can be, it can be issued
wait,
title.
that's a different people. Who are they to you? Or do you work for the title company? Because we don't like to be in this
Title is a different realm. So title needs to ensure that there's no liens and the property is being transferred with no debts to you. You only have the mortgage there. So they have to ensure there could be last minute issues, that there was a judgment not paid. So if the judgment's not paid, you're not owning that property free and clear. So there's a lot of last minute things.
I was just going to say, I don't care. Just
happen.
give me my house.
No. I can understand from both aspects because I'm an investor. I buy property as well, and I'm a lender, so I know the back end about it.
Right.
So that's why sometimes I'm used to it. Okay, you need this? Okay, here you go.
Yeah, makes sense.
Yeah.
But
just keep in mind, you're getting a big loan.
Yeah,
that's all. Keep
true.
that in mind. That's why if that's for a document, okay, this is gonna.
Ooh, I got okay.
Yeah, no, I understand. I definitely understand. A lot of it's a very emotional purchase. It's gonna be a home, so you want it to go as smooth as possible. But the number one person they're gonna blame is me.
Oh, really?
No, because if I'm requesting more documents. Why you need this? Why you need that?
Right.
There's a long list of Fannie and Freddie that we have to go by. If not, they're providing the loan. We have to go by that. They're not going to give you the loan unless you provide this information.
Yeah. Austin, do we have any questions?
Yeah, I'm going to read these questions out, so start firing off your questions. I see two questions right here, which is awesome because it's a perfect segue. One question is, can you refi out of an FHA loan into conventional? And then the question beyond that, we're going to double it. Can you, number one, and when can you refinance out of a FHA loan into conventional? And then the second question that I see right here that just happens to be a perfect segue is, I just got my first multifamily with an FHA back in September. I want to continue to get more properties. What do you suggest I do?
All right, first question.
Number one, FHA to conventional. Typically, banks would like to see some type of consistency in payments.
I keep asking questions.
So 6 months of payments is good enough for you to refinance, but the main caveat is you need to have enough equity in the house. So you need to have 80% LTV. Well, basically, let's make things simple. The house is worth 100, you owe 80. That's 80% LTV. But remember, with refinance, there's closing costs. So there's, let's say, give or take about $10,000, depending where you are and what are your taxes and things like that. So in reality, your mortgage has to be $70,000 to pay off the old mortgage, pay your closing costs. Your new mortgage is $80,000, and your house is worth 100. So that still means the 80%. That's for single family houses.
Okay.
When it comes to multis, is 75% typically.
So you said 6 months, but if you're living, that's not true if you bought a multifamily though, right? Don't you have to stay in the multifamily for at least a year before you can refinance? Is that not true?
No, you can refinance to a conventional loan 6 months.
Okay.
If you have the equity though.
So 6 months, if you have the equity, when and can you refinance? Great question. What was the other question?
I just bought my first multifamily, and back in September, and I want to keep getting more properties. What do you suggest I do?
Number one.
And what are the down payments on the conventional loans?
So number one is do your taxes correctly this year.
Pay somebody to do those.
Ooh,
Stop
that's
doing
such an
I love
interesting-
TurboTax, and I'm happy it covers us, but please do your taxes properly.
Make sure your Schedule E, you own real estate now, so you're gonna have a Schedule E when you file your 2020 taxes. So make sure at the end of the day, you have a profit or you have some type of income going in. Because if you write off a lot of expenses, but of course, if you have those expenses, if you want to write off, then go for it. But then remember, it's going to hurt you to qualify for the next property. So let's say your mortgage is $2,000 and the income on that property for that year, because you didn't own it for that many months, is, let's say your rental income was, let's say $5,000 after all expenses. Let's say it was a negative. Let's say it was a negative. Let's say it was a negative $3,000, negative $10,000. The good thing about that, we can add some stuff back to it. So the interest you pay, we can add back. Depreciation, we can add back. Let's say after we add everything, your net now on that property is, let's say 500. 500. No, let's keep it simple. 1,200.
Okay.
So what the bank will do is take that 1,200, divide that by 12. Your monthly income on that property, profit is $100. And and then your mortgage is $2,000. So basically, you're at a negative $1,900 on that property.
Interesting. And you know what's cool about that? Because
so that will hurt you to qualify for the next one if you can't carry that payment and carry the next one.
And it's so important because we'll double back on the question of when you're getting ready to purchase the next one, right? Which John has done, we have done. John has helped us on the next purchase. So if you purchase that first property in FHA, and which is why it was a perfect segue from the other question, you're able to refi into conventional under the same terms and same logistics that Jonathan just mentioned. Once that's into conventional, then you can go after another FHA. I'm going to have you break down what needs to happen in order for somebody to be a first-time home buyer twice, and then I'll talk about the taxes. But what needs to be done, if somebody, because some people have heard of it, I heard somebody use their FHA twice, or somebody heard them use their first-time home buyer's loan twice. How do you do that?
So you can definitely you can use FHA multiple times. You just can't have 2 FHA cases open at the same time unless you're moving 150 miles away.
Okay.
So if you're still in Jersey, you're staying in Jersey or whatever state you're in or city you're in, and you want to use FHA again, you have to refinance to a conventional. You have to have that equity in order to do that, and then you can go out and get another FHA loan.
California.
Pretty much.
Yes, you can, but you have to have a job over there.
Oh, so that was a good point. So we were like contemplating, and we're not contemplating, it's happening, but we were discussing real briefly with Jonathan about getting pre-approved to buy a property out in LA, which is where Asia's from, born and raised. And we were asking like, hey, if we qualify, if we go on the loan together, what can we qualify out there for? And Jonathan came back and he said, well, I don't know about y'all, but Asia can qualify for X amount. And I was like, what do you mean? Like, business is doing 6 figures. What do you mean you can't take my income? And for 1099 self-employed, the lender wasn't able to take my income because my income is based off of me doing business in New Jersey. Whether that's a realtor, whether that's a doctor, whether that's an attorney, I feel like might be the same. Where if your practice is based off of New Jersey, and if your client or source of your income comes from a book of business in that particular state, it's much harder to prove. But if an attorney or if I came and I did, maybe 3 or 4 deals or a couple of deals out in LA and was able to prove that, I think it might have been a different case. But if your book of business or the people that are contributing to your income is from a specific area, if you're self-employed, then I think that was the reason why we couldn't, necessarily do that.
Because you have your license here, but if an attorney goes to work for someone, W-2 in Cali, then that can work.
But then they're on W-2.
It switched to W-2.
Yeah, so then it makes sense.
And if you switch to W-2 in Cali, have a job out there,
then it's easy.
We can use that.
Right.
All right. So I just want to be mindful of time. We're at 8:03 right now.
We'll to piggyback off of and then I was mentioning, and when Jonathan was mentioning about like taxes and like how you claim. Here's the reality. Once you start getting assets, I can't be more like genuine about it. Once you start getting assets, once you start getting properties, once your income takes a new level of greatness and things like that, listen, TurboTax is not working anymore. The free tax programs are not working anymore. Because there's a reason why. Once you get to a certain either asset class or you make a certain income, it's called tax planning for a reason. And Jonathan will tell you firsthand, and so will Asia will tell you firsthand, come October, usually of every year, October, November, I reach out to both my accountant and Jonathan at the same time. And she's laughing because it's so true.
Email. And I'm like,
on
give
the
me
same
off this
email.
chain email.
Because the reality is, and this is why
we don't have our W-2s.
You need an awesome mortgage officer. The reason why they can just read just to see if there's any questions.
Oh yes, I'm gonna go.
But the reason why you need an open, honest, communicative mortgage officer that also invests for himself, that also has rental properties for himself, that also invests for themselves. The reasons why you need to have that connection is because I keep it strictly G with Jonathan, and I tell all my clients, like, babe, you're right in the middle of.
Oh, I'm sorry. I'm sorry. I thought I was out the way.
Why real estate in Asia? But the reality is, like, you need people on your team where I go straight to Jonathan. I'm like, yo, listen, here's what we're trying to do. As long, listen, we're ethical about it. Like, yo, here's what we're trying to do. Like, don't let us break the law, but like, here's what we're trying to do. At least on tax purposes, here's what we're trying to do. How do we make sure that we are in line with our goals for this upcoming year or 2 years or 3 years? How I file taxes today affect me years to come? Yeah. And Jonathan is always one to be on the exact email chain with the accountant of like, yo, here's what you need to do. Here's what you need to claim. Here's what to be careful for, things like that.
I, as a loan officer, I can't tell you what to claim.
Okay.
So you tell me if I claim this, what I would qualify for, then I can.
Oh, yes,
that
yes.
out.
I'm sorry,
An
yes.
officer, I can't tell you that.
I'm gonna keep it. I'm gonna keep it G. That's obviously a question and scenario for like my accountant.
Yeah.
Because the reality is like I'm like, yo, here's where we're at. Here's like when I'm looking to pay, and I don't care because like when you're in that asset class or in like a independent contractor or self-employed or business owner, you have a little bit more control. But to say that of, hey Jonathan, I'm looking to do this next year. Based off of how I filed, can I do that, yes or no? And he'll give me the yes, the green light. I'm like, yo, you filed it great. Or if not, here's where this can affect you. And that's where like I have a decision where the same way that Elon Musk or the same way that, you know, Mark Zuckerberg will come out and all of a sudden write off a grant for 200 million or 20 million because it's a tax write-off. It's like, yo, you know, do I gotta give an extra 500 to the church? Do I gotta, you know, do I gotta buy 2 laptops and write off $1,200 for my laptop? But those are conversations as far as tax planning that you want to have with your mortgage officer and your accountant. And your mortgage officer obviously going to have a certain amount like of liability and as far as like a scope of work that they can do, but they're just there to tell you how you filed and what you're going through is going to either set you up or fail you based off of your future endeavors. But they can't fudge numbers or anything like that. Yeah. But they can at least give you the idea.
Yeah, no problem. And then we'll go
so if you have
rapid
a
fire.
W-2 employer, your taxes are easy. But once, as you mentioned, when you get things more complicated, do not buy a tax alone. Once you have properties, once you have different things come into place, don't make any errors. Make that investment and
just do
use
it
that.
right.
You could use that investment as a write-off as well because you're paying someone to do your taxes.
Awesome. All right, so we know we're winding down. So one question from Presence _future. Amazing question because we were just talking about this recently. So top cities, and let's do rapid fire questions because we're at 8:18. I think we can go to 8:15 and be good. So let's do rapid fire.
Knicks don't come
Quick.
on. It's warm
Oh,
right
okay.
now.
Thank you. So top states.
Thank you, Ashley, for letting Jonathan hang out with us.
Oh, that's my bestie. All right. So top states or cities you guys would consider to invest in, coming from an agent and broker standpoint. Well, I'm neither, so I'm gonna go first. Only because I'm always talking to Austin, but I know Cleveland was one of those places. Essentially places that are like in a reurbanization, maybe? Or sort of gentrification.
Listen, and put it like this, like the easiest way I think to map it, right? Because I think like the easiest way to put it is like we know that the cities are always going to be developing, right? The metropolitan cities, basically anywhere that's on the map that you already know about without setting foot in that state. Right, so I've never been in Washington, but I know Seattle. Right, I've never been in
Cleveland,
Kansas, but I know Kansas City. Right, so Kansas City has to be like the steakhouse or whatever major metropolitan areas there are, and you'll find a common theme across pretty much all of America, at least, is that your major metropolitan areas, and think of it like an earthquake, right, where if your earthquake happened in this particular area, it's going to have the seismographs, the rings around the earthquake that venture out. Put every investment opportunity at a major metropolitan city and then radiate away from that, right? So for example, for New Jersey, for all my New Jersey folks, New York City, we don't have a major city in New Jersey. We have New York City as like the major metropolitan city, right? Where everything from New York trickles away from New York. So then, for everybody in New Jersey, we have the Newarks, we have the Jersey cities that became
Camdens, outside
long
of
story, like we can give you a list of them. Long story short, wherever the major metropolitan, not a major city, that was work, major metropolitan area, and then you revert backwards from there. It's always a great.
To add to that, depending what type of investor you are, you don't want to invest something so far and you don't have boots on the ground over there. You don't have no one. It could be a slam dunk deal, But if you don't have no one looking over you,
Great
a
question.
property manager, someone can really rip you off and you can be at a negative. So keep that in mind as well. Have boots on the ground wherever you're gonna invest, if it's out of state, and make sure you have that team. Build that team to make sure that you're able to have a successful investment.
And I think another thing that we talked about, because we were trying to figure out, okay, outside of Newark, which is, everyone's starting to hear about Newark, right? And so like, what are the places that are like Newark but are still, people are still kind of anxious about going or reluctant to go? So we looked up Cleveland, we looked up like places on Phoenix. We literally looked this
Arizona,
up.
yeah.
Cleveland, Cleveland, Ohio, Phoenix, Arizona. What were some Philly,
Austin,
Houston, but then we also, I think another thing to think about, Presence_Future said, tell Boogie I said what up. But I think another thing to think about is like, is the area already booming already? Are you gonna go in, even if it's like Houston and it's like a hood part of Houston, but is it already overly invested in? Like that it may or may not be, depending on, how, I don't know, whatever, depending on your goals, but those are things to think about. And so to your question about, are we okay capitalizing on gentrification within our community to benefit? And I think even if we're not from it, I feel like this is our way of taking it back. In my personal opinion, I'm not from Newark, but I'm from Inglewood, and it's like Inglewood and Newark, not the same, but I think could be compared to each other to a certain extent. So me investing in knowing that white people also want to live here and want to leave out of New York and have their own place and come to Newark, I don't see it necessarily as me capitalizing on gentrification. I see it as me literally owning the block, even if I'm not from here. So I think change your perspective on it, just investing in our own. Yeah, exactly right. Embody _greatness.
Man, don't.
I don't know the names, but yes, that's right.
Instagram names.
I'm sorry. All right, so I know we got just a few other.
Yeah, listen, as long as they ask some questions, answer away. As long as we're here, we're just here to.
Yes, well, I have some rapid fire questions for the both of you. So one, what are some expectations that home buyers can have? I tell a lot of people, like, you may have a date, especially in California, where their closing dates are usually like a month, like 30 days literally, and then it's like it's after 30 days and they're like stressed out. What are some like ways that we can manage expectations as buyers, with you knowing that more than likely, more often than not, the deal is probably not going to fall through, but there's going to be some challenge at some point? But from a mortgage officer perspective and from a realtor perspective, what are some, like, what would you tell a client if you could just say, this is not going to happen in time?
Keep it G.
Don't keep it 2G, but.
I would make sure you have your documents in order, not to delay that any further, and make sure we do all the steps at the beginning early, like the appraisal. Appraisal is number one. Make sure we take care of that early, and now be like, oh wait, I want to see what happens here, what happens here. Then we can order the appraisal. That time you took at the beginning to wait for that, that's the time that you're stressing about now. If we would have ordered that appraisal a little earlier, we probably could have met that deadline. So keep that in mind.
What about you?
I mean,
And be patient.
Yeah. Because I think with like real estate, like I don't think people realize like where in real estate in any transaction, you have about there's about like 20 something people working in each and every transaction, right? So like plain and simple. You have the buyer, you have the seller, you have the buyer's agent, you have the seller's agent, you have the buyer's attorney, you have the seller's attorney, you have the mortgage officer, you have the home inspector, you have the title company, you have the city inspector, you have the appraiser, you have the, and again, when I say mortgage company, I say the mortgage officer, my guy, then you have the mortgage processor, then you have the mortgage closer.
Underwriter.
Right, so like in the mortgage industry in general, you got 3 to 4 people like off the rip. Right, you have and all the people that I just mentioned that are all trying to work together to get the deal closed. So like delays in a common sense, for example, the game telephone, where the message is simple. I spy with my little eye. It starts off great in the very beginning, but for some reason, by the time that it comes back around, it comes out as I with my little eye spy. And you're like, how did, but to keep it, to put it in perspective, it's a lot of moving parts. So there's a lot of people that's doing the tango, and Jonathan pretty much put the nail in the coffin when he mentioned handling everything up front saves so much time on the back end. He talked about the appraisal. I say the appraisal, the home inspection, and as long as the seller, in a general transaction, as long as the seller handles the CO, the certificate of occupancy, whatever the seller has to handle, if everything's done in the first week and a half, 2 weeks, everything else should be able to be smooth. Now there might be negotiations, every transaction is different. But as long as you're able to take advantage of the things that you can control, it makes the transaction so much easier in the long run.
One more thing to add to that. If let's say the house under appraises, because this market
he just asked this question. If appraisal comes in below a selling price, what do you do? See, we're on the same page.
Oh, bingo. Okay.
What happens?
So
the question again is, what happens if the appraisal comes in below the selling price?
So there's a few things you can do. Number one, you can do a rebuttal. You can.
I'm so sorry. What's the appraisal?
Appraisal is a third party that the bank hires to see what the property is valued at. So he would go out, see the condition of the property, and see what has sold and the radius of the property that's similar to it. So same type of home, same garage size, same square footage size, same bedroom size. You cannot compare a 2-bedroom house to a 5-bedroom new construction. So you cannot use that as a comp. So make sure that comparable, you make sure it's a similar house in all features. So the first thing you can do is rebuttal. Make sure the house that you're going to use is similar. Don't use a new construction house versus this house sold for $600,000.
Listen, I've been trying to, John, that I've been pushing it.
It's a new construction. It's a new construction. Okay, it's renovated, but it's a new construction. So you have to have something similar to it, square footage size, bedroom count, and something similar to it. So the first thing would be a rebuttal. If that doesn't go through, then you would have to either compromise with the seller and come to an agreement, because the bank will not lend more than what is appraised at.
So if somebody's looking to purchase a house, seller's asking for $400, buyer's like, you know what, we'll give you asking price $400. Appraiser comes out, either one of three things can happen. Either one, it's going to come in at that 400 number. Either two, it's going to come above, which at that point,
happens a lot.
Okay, so it comes in above, what happens?
You have equity, right?
You have equity, now it's instant equity.
Okay, so it just means like, whatever I can sell it for. All right, so if I bought at 400 or my contract price and offer price is at 400, it comes in at 425. It just means that in theory, if I were to buy it, I can sell it for 425. All right, so then if it comes in under is what you were explaining. So if it comes in, I'm at 400 was my offer price. The seller was asking for 400. It comes in at 375. The first step will be to rebuttal it to see if you can provide documentation to see if it's worth that 400, and then if not, you were mentioning
you would compromise with the seller. So that's when your attorney comes into play, and he can see if the seller will come down on his price to 375, or he can counter and try to meet you in the middle somewhere. But if you do meet in the middle, you would have to bring up the difference. Right. So let's say you agree
LA
upon.
don't use attorneys, so.
Okay, so whoever's representing you, the agent or someone else, the title company, however that works in LA. So let's say you agree upon 385. Okay. So you would have to come out of, besides your down payment and all the closing costs, you have to pay $10,000 on top of that to pay the difference.
To make up the
and if you go that route, please have an addendum to the contract signed by both parties and give it to your lender right away. Because if you do not, you're delaying the process. Because the bank won't review, because the deal can die. Because right now they're just on hold until they have the addendum. If you have the addendum, make it right away, give it to the bank so they can, the underwriter can review it and move forward your process.
All right, because it's supposed to be rapid fire. So how do you choose? Not at all. That's all right. How do you choose I feel like we know somewhat how to choose a real estate agent, but feel free to chime in. But how do you choose how do people find you outside of people in New Jersey, but let's say people in California, people in Texas, people in wherever the heck they are. They're like, listen, I'm ready to buy. I know the first thing I need to do is get my pre-approval, but I don't know who to go to. Right now I'm stuck between Chase and some no-name, mortgage company. No shade, because we love some MLB, and I see your coworkers are showing out for you right now. So shout out to MLB right now. But like, what? Oh my God, can you get him? What would you? How does a buyer find? What are some of the ways? Do you get connected to the realtor? Tell us about that process.
So if you have a realtor already, you can definitely get a recommendation from your realtor.
Okay.
Or you can shop around. If you don't have a connection with that specific mortgage lender that realtor provided, you can shop around. Number one, what I would do is see if you have that connection with that person. Are they explaining the documents properly, explaining the process in a way you understand? Mm-hmm. If you're buying an investment property, do they own investment properties maybe, so they can help you on that angle?
That's a great point.
Yeah, because a lot of lenders, any salesperson can talk the talk, but are they able to help you when it comes down to it?
And how helpful should they actually? Because I know how you all are and like other mortgage officers that we have, and I feel like you guys just go hard for your clients in general, not just us. Like, what are some, I know for me, I have really high standards. So the first time I'm like, you didn't respond quick, oh, you did. Yeah. What are some things that people can look out for to know? And if they notice any of those things, can they switch a mortgage officer in the middle or mortgage company in the middle of a purchase?
Yeah, you can definitely switch in the middle. It just can delay your process because you're going to start all over again. Remember that. So
I can't have my appraisal sent over from the one company to the next?
It depends on the appraisal company. They have to redirect it to the company, but a lot of people will just try to charge you again and go out, so it can get complicated. So what I would recommend is shop around, see online, Google good reviews. As you mentioned, if you keep calling someone, they're not picking up, good possibility going to the next one, because if they're not picking up now, they're not going to pick up later. But keep in mind, people can be in the middle of the transaction. If they don't call you back, that's a red flag.
I'll leave you with this, because I want to double down on our question just to make sure you answer it. But I had one transaction literally last year in the summertime, and we're about a week and a half from closing. Mm-hmm. The mortgage officer falls off of the face of the earth, and I'm not talking about for a couple of days. I'm not talking about we were, me and the buyer are like, yo, he must have caught COVID. There's no way that and it was the first transaction I've ever seen like this, where the mortgage officer literally dropped off the face of the earth, didn't pick up, didn't respond, we literally had to close the deal with the company and calling the main office. Mm-hmm. So to your point, that's the service aspect of going. I don't even think that's going above and beyond. Just fucking mercy, just be there for your client. But a great question that I get often, and Asia already pointed at it, was, what's the difference between a lending company, a mortgage lending company, and me going to Chase, or me going to TD Bank, and me going to JP Morgan?
We're going to have to have a separate one for that.
A lot of different factors.
They got a different question over here. Hey, Kadeem, shout out.
There's a lot of different factors come into play. So number one is service. You're not going to have a main point of contact with a big company. So you're not going to have a main point of contact in a big company. So with a smaller bank, you can get me. You can always call me, see what's going on with the process.
Easy.
When you go to a bigger bank, one person handles one part, another person handles another part of the transaction. They don't communicate with them because they're such a large company. You have to call this person instead of me. Okay, you calling me? All right, let me take care of that for you. I'm gonna find out for you.
Yeah.
Another thing is the lending criteria can vary. Mm-hmm. Chase, I think recently they may want you to put more money down. Rates will be different. Rates will be higher depending if you're like maybe a private client. If you have a high net worth with them, maybe you could get better deals. But if you're a regular Joe Schmo, like people say, then rates will be worse. So yeah, I would say number one is definitely service and rates.
Yeah, and which I think count
It's
the
main-
most when
it's
something
the main
isn't
thing.
working,
It's the main
when
thing.
something
There's
isn't
nothing
going
else.
right.
There's nothing else.
I think it's a benefit for your agent to be able to like call and reach out to the mortgage officer, even for like a family situation that we had. Like Austin and I ended up calling the mortgage officer, and it was a little bit more, like I work at a Fortune 500 company. There's no way that you're gonna call us after 5 o'clock and then like expect to get all like that's not gonna happen. No shade on that side of life, but that's just sometimes that's not the reality of it. And so I think that's something to really, really take into account is like where like the types of companies. So look at your IG. I look up tags all the time on Instagram. Like I'm looking up New Jersey. Today I looked up New Jersey plumber. I would do the same thing for like New Jersey mortgage officer, New Jersey like mortgage company. Like those are ways that you can still find some really great
And
people
look at the report card,
and-
reviews.
and the reviews too. I think those reviews tell a lot. You don't want to see my Yelp reviews because I go real ham on people, but I think that they're valid because it's actual people saying how they actually feel. So that's a plug for Jonathan also because I think he does really amazing work. But
There's one other question. I'm sorry, but it's such a good
Austin
question.
wants to answer the
No,
question.
it's such a good question, and because I get it a lot. When it comes down to grants, somebody comes to you and they're like, "Hey, Jonathan, like I heard like there's my friend, my cousin, they got a grant program. Can I do that with you? What does the grant entail? Because I know everybody like." And I can't knock it. I can't knock it at all.
Yeah, me either.
And a lot of people like try to find the zero, low money down options. Not knocking it at all.
But what are the downsides?
So we want to talk about like
there's
not the
good and
competitive
bad.
aspect of it, but like what do you say when somebody asks you like, hey, what grant programs do you know? Because I usually refer them to the mortgage officer if they like were to ask me. I'm like, I don't know, ask Jonathan. Like,
So there's different grants. There can be some banks that if they did something in the past and now they have to give that money back, it's basically yeah. That's one type of grant, and there could be a city grant that if they try to entice people to go into the city, there could be a grant for the city, and then maybe a county grant, different type of grants. But not all companies will take the specific grant. Right now, we don't have any grants going on in my company. But the bad part of the grant, not everyone qualifies for the grant. So there's specific income limitations, credit limitations. So keep in mind, it's not everyone will qualify for that. And they also, I know there's certain criteria for that grant. They won't allow you to sell or refinance in a certain time period. So keep that in mind. So if you want to continue to buy, it's going to be tough doing that with a grant.
Right. I get a lot of those like, hey, I heard like this grant if I do this program, and do you recommend it? I'm like, one, I don't know. You have to talk to the person in your state or whatever because they're more familiar. But I think that's a great question. Any other mortgage questions? So you'll be able to find these tags, Jonathan, and all of our things. If you want some other people, we have
We're on
some.
the podcast running it heavy. We bringing through it like crazy. We bringing all the content into y'all. The reality is like, he's a mortgage officer. Don't let him fool you. He's also owns 10 units, 11 units. Look, he forgot. That's all that matters. Look, if you forget how many units you own too many. So I need y'all to like understand, like this is not just he's counting. He has to count.
11, 12.
Okay, 11, 12, right? If you 11, 12 in the same breath, like there's a problem. There's a good problem. Oh yeah, I forgot. I bought this one last year.
We're looking for another one right now.
Exactly. So he doesn't know what, but these are good things because especially for everybody, which like for the most part people are tuning in that are like investors as well. Like this is why it's so important for your mortgage officer to also invest. Like who also owns units. Not 3, not like he just bought a 2-family, his first 3-family, and used his own FHA from his company to. No, I'm talking about double-digit units of like ownership, and like he obviously he's not stopping there. So like this is why we're bringing like these types of guests through, so that way, yes, we are going to tell you how to buy your single-family home. We are going to tell you like the pros and cons, but we're also going to teach you how to go above and beyond with the units and the rental properties. Beyond just your first purchase as well. And that's
Listen, but I will say this past week, especially with like the snow we've gotten in New Jersey, it's really the multifamily life, the owning property life, the landlord life. This stuff is not like
whoa, that's a separate episode.
It's a separate episode, but I think this is going to lead up to the next, because the reality this stuff is hard. This stuff is not easy. It's not HGTV,
it's not
and it's not for everyone. So if you want the multi-family life, then we got you. If you want the single family life, we got you. You know, like I feel like there's a space for all of us here, but we want to acknowledge the fact that we know everyone isn't interested in like in being a multi-family owner, and that's okay. Like at the end of the day, I think we all care about ownership. Okay, wherever it is, if it's in Arkansas, if it's in Texas, if it's in Newark or Camden or Middlesex, like we just care about like people of color owning and being able to say that they have a stake in their communities, wherever that is. And so I hope that you guys get that from us. We totally appreciate y'all for joining. I see another question, and if, depending on the question, Austin may. Someone said how much percent of retirement brokerage 401k accounts do underwriters consider? I never even tell them anything.
That's such an interesting question.
So you can use your 401k as a down payment or reserves.
Ooh.
So if you have a 401k, you can use that as reserves.
Tell us more.
And
So basically, the money that you were setting aside already to invest with, that your employer is matching.
Mm-hmm.
And this is ownership on all levels. Like this is like whether you like own your own business and then just like buy your single family property. Like it doesn't matter. Like real estate just might not be the whole like. Do you know how many people like own like more amazing assets than real estate? Plenty of people. So this is not like a only own real estate and do nothing else. That's the stupidest thing ever. But to that point right there. Let's talk about that, because I think that's a very
So you can definitely.
But he gotta go home to his wife soon, so we can't hold him hostage, because my girl Ashley, she probably like, where my husband? Okay, go ahead.
So for 401k, you can use your 401k for your down payment and closing costs. So a lot of 401ks, you can take a loan, about 50% of that, to use for your down payment and closing costs. You're just paying yourself back. Just think about the opportunity cost. That money could have been growing with the stock market, but instead of growing there, you could take a loan out to buy your first home. Let's say you're buying a multifamily. That makes sense.
I got a question from my girl Jessica.
Hold on 1 second, babe.
Whoa.
No. Just.
I want to ask the question.
Do you have to? When you say a loan against your 401k?
Loan against yourself.
Okay, so 50k is in the 401k. 25k. When you say a loan,
do you have to pay taxes on that?
You take the 25k. You apply it for the down payment. How do you pay?
You're paying that back yourself weekly in your checks.
Oh,
and
interesting.
let's say if you leave that job and you don't make those payments, then that becomes income which you pay taxes on. Because
it's tax free.
It's yeah.
So until you ax the root of this is what kept me tax free.
Mm-hmm.
That's interesting.
Great. So I got a few.
I always thought that you could just pull it and then use it, but not like having it actually as a loan.
You gotta pay it back. If you don't pay it back, that's early withdrawal. Then you gotta pay taxes
and all that good stuff. Okay. 10%. Question. So going back to a little bit, and this is the California side, because they are just getting off work. I'm like, what time is it? They just getting off work. We got y'all. Period. We got you. So do you suggest to use a VA loan versus going FHA on a first-time duplex property? So for context, LA is usually not like you can find some gems of triplexes and plus that, but typically duplexes is easy. They're low. You can have one door here, one door here.
Okay.
So, do you suggest to
VA
use a VA loan versus going FHA on a first-time duplex property?
So VA, it's a little tricky when it comes to multifamilies. So for FHA, if you have no landlord experience, you can use the potential rental income, 75% of that, to help you qualify for more. VA gets a little tricky. If you don't have landlord experience, you can't use the rental income. It's only your income to qualify for that property. If you can still qualify for that property, I would go VA loan. But VA, as we mentioned, 56, 46, all that percentage, VA is a little different. It doesn't really have a set bar percentage-wise, but it's more flexible than, it can be more flexible than FHA.
So VA, you need to have landlord experience in order.
Rental income.
But that doesn't mean that you can't use it. But
if you qualify for it, VA 100%.
so if you qualify to purchase the duplex,
do it.
Without using a VA loan.
Because you're not paying mortgage insurance for VA.
Okay,
Remember that. And you're buying the house for 0% down.
got it. That makes sense.
Interesting. I never knew
And
that.
then a question we got is consultation fees.
How do they?
How do you? Oh, can you use? Okay, so I see. Can you use part of your Roth as reserve?
Yeah. Any funds you have in a retirement account that's tax deductible, you put it pre-tax or post-tax, which is the Roth, you can use as.
Do you have to
reserves.
borrow against it the same way as a 401k? Because you're
So
not
with the
necessarily
Roth,
paying it back.
after a certain amount of years, you can pull money out tax-free.
Yeah, but it's
So
like isn't
you
it like
just-
6? Isn't it like a lot of years? Like
No, with the
decades?
Roth,
No,
because
with the traditional,
with
yeah,
traditional,
it's
you know,
65,
it's
but
different.
the
Roth
Roth-
is you're basically putting money in after you pay tax already on that
Yes.
money.
okay.
So you can pull money out what you put in, but I believe on the growth you can't pull out. So I would speak to your CPA or someone that knows more about that on the
Implications,
penalties.
I guess. Yeah.
Yeah, with that, but you can't use that as down payment.
Towards okay, and then
Sorry, go ahead, babe.
for people who want to leverage you all for like consultations, I think this is a great question because I think I feel like we want to make ourselves available, but at the same time, like I want to get your thoughts. But like for agent perspective and from a mortgage officer, if somebody's just like, hey, I just want to kind of talk to you about, I'm not ready to necessarily get my pre-approval, but can I talk to a mortgage officer or can I talk to a real estate agent? Give me the appropriate tone, or if you charge consultative fees for having like investor conversations separately.
Yeah, if you want to have an investor conversation, we can definitely talk about a consulting fee. If it's something like out of state or something in state, whatever the case is. And if you're looking to purchase in Jersey, you can definitely book a consultation. I have the link in my bio. We can definitely talk about getting a pre-approval for a mortgage.
And you, Austin?
Well, how these Instagram influencers be coming out? You know what? I'm booking $99 per consultation because considering the fact that we got Instagram influencers that own one home with 2 units, and all of a sudden, like they got
They get
$1 million courses
$7,000.
and all that other stuff.
Yeah,
and you know
so
what?
annoying.
$700 for my consultation fee. So whenever you're ready, link is in the bio. $700. You get 40 minutes. And we can run through all of it. No, I'm just kidding. But the
I'm
reality
like, no,
is,
and she's North Star, so that's not that's a no.
To be honest with you, people, I'm totally an open book. I was having a conversation with an individual, which I don't know if he's on or he'll see it, but I was on a conversation with an individual from Washington. I can't serve him. I can't make any money off of him, but I talked to him for an hour and 45 minutes. He'll tell you like off the rip. And the crazy part about it is that he was asking me stuff to go to his agent to talk to it. So you know, like I said, like it's not about the money. We're really trying to genuinely just once we can't serve everybody, like you know what I mean?
People will know.
But at the same time, like you know, we just love our industries and our careers so much that we just want to provide value. It's very simple.
And
Like,
you can
we just
also
wanna
just
provide
reach out to
value.
me, and I will be able to give you all the answers you
Yeah.
need.
John just said it best. Use me, just don't abuse me.
Wait, I have one more question. I think this is good. Steph, don't worry. I got you, okay? Period. And that's how you gonna get all the love. If you purchase a home with somebody, do both, so we gotta clarify.
Okay.
We gotta clarify what that means, okay? Are they on the same? Are both names on the title?
Unfortunately.
Are they both paying? Or did they just give you money? But the question is, if you purchase a home with someone, do you both need to live in the property to qualify for an FHA, or just one of you?
Okay.
That's an excellent. Okay, North Star. Yes.
Single family home. There's something
Love
called a non-owner occupied borrower. So the first person can be the primary person, and then the second person can be added that's not going to live there. When it comes to multifamily, you cannot have a non-owner occupied borrower. So if both people on the loan, FHA, they would have to live there.
That's interesting because it's like it's. I don't think most people like actually think about that, right? Like where on the multifamily end, right? So like a lot of people are like, yo, I want to get started. I'm ready to go. X, Y, and Z. Da 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 da. But they might be on the younger side, right? Where like maybe they're just finishing high school or like they're like getting into college and then they're asking like to prepare themselves. And I'm like, yo, a very general thesis and your broker, your office pretty much gave us like the runaround on like that podcast episode where it's just like, yo, between 10,
coming soon.
10 it's coming through. You got my text already about it today. All right. So 10 and 15,000 is a great starting point, at least for everyone that's in New Jersey. I'm not talking and Northern New Jersey. I'm not talking about Ocean County, New Jersey. I'm not talking about Atlantic City, New Jersey. I'm not talking about Houston, Texas. I'm not talking about freaking Inglewood, Los Angeles. I'm not talking about, I'm just talking about like New Jersey. 10 to 15. If you're not in our particular demographic and area and geolocation and everything like that, just take 3.5% of whatever the typical average purchase price in your market is. That's going to give you what you need as a down payment. Whether you need to do that yourself or whether you need to get in a partner to split the cost is a totally different story. But honestly, already, like Jonathan's already answered the question about like what happens if there's two people. But I just think that it's not a question that's like thought about because like I think most people are pretty much like, well, yeah, let's split it. I'll put the house let's put the house in your name. I just want to like help you finance it and like let's split the profits off of it. But off of a multifamily, you're saying that if I found a multifamily, which is a great deal, and my down payment is $10,000. And if I didn't have the $10,000 myself, I bring in somebody or I bring in a family or a friend and they're like, hey, well, I'll split the cost with you.
So that person would have to give a gift.
So they have to do the gift. If they want to be on the property with you, then
they can be added to the loan if they want.
Added to the loan, are they? If it's a multifamily, they're added to the loan. Mm-hmm. They're automatically added onto title.
If they're on the loan, yeah.
If they're on the loan, they're on the title. So anytime that anybody, the first main individual wanted to make a decision whether I wanted to sell it, he has to get that, he or she has to get that other individual's signature to sign off on it. Mm-hmm. Mm-hmm. Yeah, and they both have to qualify, like both of their incomes and stuff like that will be.
If both incomes, it will be they qualify better because if it's more income involved and if that's the income ratio, should be better depending on the second borrower credit and what debt they have.
So if the first borrower is not, well, then again, I think I answered my question because the first borrower wouldn't have been approved per se. But if the first borrower had, maybe their credit score was out of range. So if they're going out to FHA, maybe their credit score was at 550, but their cousin, you'll do both.
Yeah, if it's 550, they won't.
But your cousin, and they want to buy the home primarily, but their cousin has a better credit score, better income, and they're like, yo, let's do the deal together.
Does the cousin need to live in that place?
The person with the 550 won't qualify because the bank will look at the lower score of both.
So they wouldn't even qualify anyway.
I would say the other person buying that person's name, they qualify by themselves, and then have some type of management company that you manage the property, and then once the second person has better income, better credit, I should say, have that person buy the second property, and then the management company will manage that property.
So then the other person would have had to been the primary borrower, basically. At least if their credit was right in there. Okay.
Great question, Steph. So I think that is.
We got one more.
Oh wow. Wait. I'm sorry. Let me just go over here. Hold on.
We got one more.
And listen, and I'm okay to go on. I just want to make sure.
No, we just want to make sure that.
It would. Oh, she's saying it would 99% be a single family.
The good thing about single family, so non-owner occupied. So
that's easy.
That's pretty easy, straightforward. And if the main person has been paying the payments, let's say 12 months payments, and the other person want to buy a house, the non-owner occupied, single family, they can prove that they're not. It's on their debt, but they haven't been paying that, and the first person can prove that they've been paying by themselves, and the second person that wants to buy, we don't have to use that debt.
Perfect.
Great question.
So it can help the second person go out, because I know a lot of people can be iffy about being a co-borrower on a loan. It can also be temporary as well.
Yeah.
If you income increases or you pay off some debt, you can refinance and remove them.
Yes. I'll leave you with this. I had a transaction 2 years ago, and I'll leave you with this. So sorry. The reality is, like, I need people to understand, like mortgage officers or mortgage. This is not it's not an apples to apples. Like, just because like one mortgage officer is great doesn't mean that the other is going to be. And it didn't make sense to me, especially when I first started in real estate. Simply because I thought, like, at the end of the day, like, all the loans are going to be the exact same. I actually want to start this tradition where, like, the guests all cheers really quickly.
Oh, well, cheers.
Salud. Yes, beautiful.
Cheers. And listen, if you're going to clink, please clink at the bowl of your wine glasses. Don't clink at the top here so it doesn't crack the glass. Okay?
Oh, that's wine etiquette.
You're going to clink at the bowl. Just
so
FYI.
Long story short, 2 years ago, the mortgage officer in the mortgage company was absolutely terrible. And here's what I mean by that. They didn't realize that they can pretty much set up the primary borrower and their, and their helpers as non-occupying home borrowers. So what they were trying to do, whereas in Jonathan's case, he would have looked at it like, all right, we have our primary borrower, our borrowers, it could have been a husband and wife, doesn't matter, or it could have been a single individual, whatever the case. But he would at least ask if there was the potential for non-occupying co-borrowers to help them apply for the actual loan. The issue that I ran into was that the individual had, or the company had the individual mortgage officer had no idea that they can tack on their family members as non-occupying home borrowers, thus increasing the purchasing power of the primary borrowers. Because of that, long story short, we stayed in the deal for about 7 to 8 months. Ooh. And then it wasn't until, which shout out to Chris, I always will shout out Chris and Jersey Mortgage, but the reality is, like, Jersey Mortgage just, they bother me a little bit, and I told my my other mortgage officer just off the rip of just, I can't, like, deal with y'all if you're still with this company. But he saved the deal simply because he changed the loan so simply to a non-occupying home borrower. And it was a game-changing of a deal. We got the deal closed in 30 days. But that's the reason why I put so much emphasis on working with a mortgage officer that just, one, knows what they're talking about and has been through that. And then, like I said, like for anybody that's looking to invest and go off the, go more in depth with what they're looking to do later, which is why Jonathan here just buying properties himself, like he's in the mix and he just understands. So
Yeah, look, if I don't know the answer, I'm gonna get the answer for you. I'm gonna make sure your deal closes. Either we have to add another person, we're gonna have to.
and Jonathan
figure
shows up
something
at his
out.
closings.
Yeah. So we make sure till we go to the closing. We make sure I get you to the closing table. If I pre-approved you, I'm gonna fight for you until the closing table. A lot of loan officers will just let deals die because they'd rather focus on the other deals. No, I want to make sure everyone gets the attention they need, service they need for home ownership. So I'm gonna get you to the closing table. Remember that. I'm gonna fight for you.
Yes. All right. So I know that we are at the end. We did. I'm sorry. I hate to keep bringing up more questions, but people keep joining. And so one question was, if I bought a property in FHA, can I? And I have a strong credit score. Can I use? Can I, refinance into a conventional loan if I have a strong credit score of 700 plus?
Right there,
Yeah,
30-second
you
answer.
can. The main factor for that refinance is the equity. If you have enough equity to refinance to a conventional.
Perfect.
So credit score is good. Now you need to ensure your equity is there.
Perfect. And you guys see us drinking, we're about to wrap up right now, but if you guys see us drinking anything right now, we just popped open the JonDoesRealEstate Pinot Noir Vintage 2016 from Patagonia, Argentina. It's not it's not a super important region that you would think about when you think about Pinot Noir, but it is a region that does produce some high quality Pinot Noir, and so that's what we're drinking right now. This looks a little bit different than what we've had before compared to our California Pinot. I don't see the purple, I see more red.
Yeah, this is very
I see a little bit more red here, I still say medium red, but it has been chilled for a minute, so it does probably need to aerate. But just knowing what I know about Pinot Noir, that the Argentina Pinot Noir is probably going to have very similar characteristics to the California Pinot Noir, so very fruit forward, not as earthy or herbal as the French Pinot Noir that we've tasted. But thanks so much for joining us, y'all. I mean, we didn't have any more. We good, right?
Yeah, we discussed a lot.
Yeah, we definitely discussed a lot.
We did. So we're gonna make this a thing. So we'll have different people. We may have Jonathan on again just to talk actual investor life.
We do. We have to.
We'll have to talk just investor life. But thanks y'all so much for joining, and we'll talk to y'all soon.
Be on the look for the podcast. The podcast is coming up.
Cheers, y'all.
We bringing the podcast back. The podcast is coming back with full vengeance. Best believe. And we're just bringing straight gold to you.
Thank you.
All your real estate questions. All your real estate questions, needs, comments, concerns.
And wine too. Don't forget the wine, okay? Because I'm here to try to make sure that when we go to wine tastings, we know
110%.
exactly what we do, okay?
Listen, we're trying to wine taste with 50
Cheers,
units
friends.
in ownership. We're trying to wine taste with 50 units in
Normalize
ownership.
luxury. Hashtag normalize luxury.
Shout out to the good bro, George Darby.
Uh-oh.
Yeah, he knows.
Thank you.
And
Austin always does.
shout out to the mom. We know who it is. And for anybody who's on the call or anybody that views the content after, George Darby is also, let me know, who's also handy.
Cheers, y'all.
And great with his hands. So if anybody needs just extra work done around the house or anything like that, please let me know. I don't want to sign him up, but he signed his death certificate for himself. So anybody needs work around the house, cosmetically or anything like that, George is amazing. Let me know. And as far as his wife, best believe when it comes down to, if anybody's, which I know COVID maybe changed some things, if you're throwing an event or if you're throwing anything that maybe requires some catering or anything like that, His wife handles amazing soul food that y'all can have at your event. So just definitely let me know. I'll put you in contact with.
Okay.
Asia, shout out anybody.
Yes,
Jonathan,
thank
shout
you.
out
Cheers,
anybody.
y'all. Clink, clink. Yay. Clink,
Anybody?
clink.
You want to shout out anybody? You want to shout out?
to the kids and the missus.
Shout out.
Yes. Hi.
Shout out to my
Hi,
tenants,
bestie.
my good tenants.
Yes, we appreciate our attendance because we appreciate y'all.
But some
Yeah,
of the
just look at how much you paid in principal last year and how much your equity is going up. Thank you, tenants.
That's true.
Yeah.
It's still stressful.
yeah, we're gonna
Thanks, y'all.
Landlord life is not for everybody. Is
Okay.
it worth it? Yes, it's
110%. I got a
When I
post that's
go
going
back,
up
when
tomorrow.
I go back and do everything all over, yes, I would do this. I would make the same
110%.
decision.
Would I do it over again? Not so sure. No, I'm just kidding.
Yo, be on the lookout, please. We're bringing out more content. We're gonna bring out all the stuff that we know. Yeah, bring it on.
It was a
Shout
pleasure
out.
having me. Thank you so much. I appreciate it.
Nah,
Yes,
I
of
love-
course. Want me to?
Yeah, you can. How do you save it after?
It'll let you.